Okay, let's go over this partnership liquidation. Here's what it says. A local partnership is liquidating. It has only two assets, cash of $10,000 and land with a cost of $35,000. All the partnership liabilities have been paid. So the partners are personally insolvent and they have capital balances and share profits as what you can see here. Okay, and then here's our first question. So we've got 25, 15, 5 to BF and S respectively. And they share profits 40%, 30%, 30%. So the first question says if the land is sold for $25,000, how much cash will each partner get? Well, let's slide this down. Now, there's the answer, but how do we calculate it? Well, we calculated it by what you see on the screen here. Jot down what their capital balances are. By the way, if you add that across, 25, 15, and 5, what do you get? You get $45,000. That's equal to the cash balance in the land. Hopefully that makes sense to you because the accounting equation has to stay in balance, right? Assets equal liabilities plus equity. They told us there's no liabilities. The liabilities have all been paid. Okay, so the assets equal equity, so that's in balance. So what we've got to do then is think through what happens when we sell the land. Well, when we sell the land that had a cost of $35,000 and we get $25,000 for it, we've got a $10,000 loss. Well, we need to split that loss according to how we share profits and losses, 40, 30, 30. So if we split the 10, 4, 3, 3, we determine how much cash is left to distribute. Now, hopefully that should make sense to you because we started with 25, 15, and 5. That's 45,000. We're getting rid of the land for 35,000. We're getting 25,000 for it. So we're essentially starting with the book value, recording the 10,000 loss, and we're thinking through where the land will go away, replaced with cash. So that really is the cash balance, 21,000, 12, and 2. All right, so now let's look at the second situation. What if the land is sold for $15,000? Well, if it's sold for $15,000, then here's the logic we have to use. Let me slide up so you can see this a little bit more. Okay, so now what we have is the situation where the loss is $20,000. We're going to split that 4, 3, 3. And when we do that, 40% to brown, 30% to fish, and 30% to stone. Stone goes negative. So he goes negative by 1,000. So we have to put 1,000 back in to cover him. If you think about it, that 1,000 that we cover has to be split between the remaining partners, and the remaining partner split would be 4, 3. So take 40% of it and 30% of that $1,000, the 4, 3 split. Okay, now remember that 571 is by taking $1,000 and splitting it 4/7, right? So 571 represents 4 divided by 7, whatever that percentage is, times 1,000, right? That percentage should be 57.1%. And then 3 divided by 7 should be 42.9%. And that's how we're coming up with those numbers. So we have to reallocate Stone's deficit to the other two partners. He gets 0, and these are the cash amounts that Brown and Fish will get. Okay, next, if the land is sold for $5,000, how much will each partner receive? So now we've just got a different case, but it's pretty much the same as the B situation. Meaning, what are we going to do? We are going to write down the capital balances. Now we're going to allocate the loss of $30,000, right? At 45, and it was $35,000. The land is sold for $5,000. It had a book value of $35,000. Land is sold for $5,000, so we've got a $30,000 loss. Allocate the loss 433. 40% goes to Brown, 30% goes to Fish, 30% to Stone. Now we see Stone is already in a deficit position in terms of his allocation of a loss. So we allocate $4,000 to him to bring his cash balance to 0, and we have to split that allocation which is shared between Brown and Fish. Again, 4/7 and 3/7. And that's how we get the split allocation. We allocate that loss, and that would be the amount of cash that would be distributed to Brown and Fish.